Buyers don't pay for what you earned. They pay for what's real. If you don't understand the foundation of business valuation and EBITDA adjustments, you could be leaving hundreds of thousands on the table when selling your business. When a buyer looks at your company, they don't start with net profit. They strip out interest, taxes, depreciation, and amortization. That gives them something we call EBITDA. But the EBITDA in your accounts is only the starting point. The real number buyers use is what we call adjusted EBITDA. Buyers are asking one simple question: what level of earnings is sustainable and transferable after the deal completes and ownership transfers? Everything else gets normalized. Let's talk about owner compensation. Many owners underpay themselves through salary because they take dividends or other forms of remuneration. Buyers will adjust EBITDA to reflect a market rate salary for the role the owner is fulfilling. Why? Because after the deal, the buyer either has to pay the seller a proper market salary if they stay, or hire an external person to take over the role. That cost impacts sustainable EBITDA and therefore value. For example, if the owner currently takes $50,000 in salary, but the market rate for the role is $150,000, the EBITDA will be adjusted downward by $100,000 to reflect that true economic cost. Next are non-recurring costs. Recruitment costs, office relocations, IT system projects, or exceptional marketing spend. If they will not repeat, you should push for buyers to add them back. Buyers will only agree to this if they are genuinely one-off. Keep a keen eye on what are continuing costs and what is once off. Related party transactions are also considered. Family members on payroll, rent paid to your property company, or consulting fees to connected entities. Buyers reprice everything to market terms. Buyers apply a valuation multiple to adjusted EBITDA, not reported profit, if your accounts show $1 million of EBITDA. But after adjustments, the number becomes $750,000. At a 5 times multiple, that is a $1.25 million difference in valuation. Same business, different number. This is where deals move and sellers lose out. If you're planning to sell, prepare your adjusted EBITDA before going to market. Document every adjustment. Support it with evidence, but also be realistic about what is sustainable, because buyers do not pay for accounting profit. They pay for repeatable cash flow, and adjusted EBITDA is how they measure it. Like and subscribe for more business exit content.